Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Precedent Transactions Analysis, a complete guide for beginners. Precedent Transactions Analysis, a guide to understanding valuations and M&A strategy. When companies consider mergers, acquisitions, or raising capital, they need a clear view of value. Precedent Transactions Analysis helps by reviewing past deals to estimate what similar businesses are worth. It's a trusted tool for identifying trends, setting benchmarks, and shaping strategy. Whether you're an investor or advisor, understanding this method can help you make smarter financial decisions. What is Precedent Transactions Analysis? Precedent Transactions Analysis is a method used to value a business by looking at the prices paid for similar companies in past transactions. It's a go-to approach for investment bankers, private equity firms, and financial analysts when determining fair market value, especially in mergers and acquisitions, M&A. By examining historical deals, this analysis provides a real-world benchmark rooted in actual market behavior, not just theory. How does it work? At its core, Precedent Transactions Analysis identifies and evaluates past deals involving comparable companies. The purpose is to find pricing trends and valuation multiples, such as enterprise value to EBITDA, EV, EBITDA, or price to earnings, P/E ratios. These multiples are then applied to the target company, allowing analysts to estimate its potential value based on real data. The key assumption here is that the market conditions and motivations of buyers and sellers in prior transactions still apply to the target company today. This isn't always the case, but it gives a realistic starting point. Why is it important? This analysis shows what buyers were willing to pay under similar circumstances. It's especially relevant during negotiations, whether you're selling a company, buying one, or advising on the deal. There's no guesswork. It's rooted in transactions that actually happen. Here are a few reasons why it matters. Market-driven insights. It reflects real pricing behavior, not speculative valuations. Negotiation power. Helps parties justify their pricing expectations with data-backed examples. Comparable benchmarks. Guides decision-making by showing how similar deals were structured. Whether you're an investor or an analyst, understanding precedent transactions ensures you're not overpaying or undervaluing. What makes a deal comparable? Not every past transaction is relevant. Analysts focus on deals involving companies with similar industries, sizes, and financial profiles. For instance, industry. A tech company isn't directly comparable to a manufacturing firm. Revenue and EBITDA. Companies with similar financial metrics are better benchmarks. Timing. Older deals may not reflect current market conditions, regulations, or trends. Geography. Regional differences in valuations can be significant. By carefully selecting comparable transactions, analysts ensure the results are as accurate and meaningful as possible. Factors that influence precedent transactions. No two deals are exactly alike. Several factors can affect valuation multiples observed in precedent transactions. State of the economy. Bull markets can inflate valuations, while recessions lower them. Strategic versus financial buyers. Strategic buyers might pay a premium for synergies, whereas financial buyers focus on potential returns. Control premiums. Buyers often pay extra to acquire a controlling stake in a company. Competing offers. Bidding wars drive prices higher, impacting valuation benchmarks. Understanding these nuances helps adjust raw data to better reflect the situation at hand. Limitations of Precedent Transactions Analysis. While powerful, this analysis has its limits. Market conditions, motivations behind deals, and how recent the transactions are all impact relevance. For example, if a major buyer overpaid out of desperation, using that deal as a benchmark could lead to overvaluation. Additionally, private deal terms often aren't fully disclosed, which limits the data pool. Despite these challenges, Precedent Transactions Analysis remains one of the most trusted tools in finance for its grounding in actual market behavior. The importance of Precedent Transactions Analysis. Precedent Transactions Analysis plays a critical role in understanding how businesses are valued. By studying real-world deal data, It gives professionals a clear picture of what the market has paid for comparable companies. This method isn't just theoretical, it's rooted in historical facts, making it an essential tool in financial decision-making. Role in mergers and acquisitions. Mergers and acquisitions, M&A, rely heavily on accurate pricing, and precedent transactions analysis is key to getting it right. Think of it as using a map before setting off on a journey. It helps guide the process by showing what others have done in similar situations. For buyers, this analysis provides insights into what a fair price might look like for a potential acquisition. Sellers, on the other hand, use it to justify asking prices and ensure they're not leaving money on the table. Without it, negotiations would feel like a guessing game. In addition, precedent transactions analysis helps M&A teams gauge the competitive landscape. Were past deals driven by industry trends? Did strategic buyers pay a premium? By identifying pricing patterns, companies can develop smarter deal structures to align with historical norms, or challenge them when appropriate. Benchmark for valuation. When valuing a company, it's tempting to rely solely on accounting metrics or forward-looking projections. But precedent transactions analysis offers something different, a real-world benchmark. By analyzing previous deals, it provides a tangible reference point for what businesses with similar profiles have been worth. For investors, this insight is priceless. It can anchor valuation discussions and prevent overpaying for an asset. For example, if historical data shows companies in an industry typically sell for 8x EBITDA, but one deal skews dramatically higher, that outlier can be carefully scrutinized. Are there unique factors in play, or does the premium reflect unrealistic expectations? This benchmark also acts as a reality check in volatile markets. While sentiment-driven valuations can create wide swings in price, precedent transactions provide a grounding reference that reduces the risk of emotional decision-making. In finance, having this kind of guardrail is invaluable. Key steps in conducting precedent transactions analysis. When conducting a precedent transactions analysis, following a structured approach ensures accurate and actionable results. This process involves identifying comparable transactions, collecting relevant data, and analyzing key metrics to formulate well-grounded conclusions. Identifying relevant transactions. Finding comparable transactions is the cornerstone of the analysis. The goal is to select past deals that share similar characteristics with the target company. But how do you know if a transaction is relevant? Here are some critical factors to consider. Industry and business model. Choose transactions involving companies in the same or closely related sectors. A software firm isn't comparable to an industrial manufacturer, even if revenues align. Size of the company. Look at financial metrics like revenue, EBITDA, and market capitalization to ensure the companies are similar in scale. Timing. Focus on recent transactions. Market conditions change quickly, and older deals may no longer reflect current trends. Geography. Regional differences in regulations, customer behavior, and market dynamics can affect valuations, so prioritize transactions within the same geographic scope. Start by compiling a comprehensive list that meets these criteria, but don't forget to refine it further to eliminate outliers or less comparable data points. Gathering data on transactions. Once you've identified your set of comparable transactions, the next step is to gather detailed information about them. But what kinds of data do you actually need? Here's a quick breakdown. Deal value. The total consideration paid, including cash, stock, and assumed liabilities. Transaction structure. Details on payment methods, e.g., cash versus equity, and whether it involved a partial or full acquisition. Valuation multiples. Common metrics like EV, EBITDA or P/E ratios to compare pricing across deals. Target financials. Revenue, EBITDA, net income, and other relevant financial data for the acquired company at the time of the deal. Strategic rationales. Were there special circumstances, such as synergies or control premiums, influencing the price? To find this data, tap into diverse sources. Public filings, SEC filings and annual reports often disclose transaction details for publicly traded companies. Press releases. Acquire data from announcements made by companies about their deals. Financial databases. Tools like Bloomberg, CapIQ, and PitchBook are go-to resources for deal specifics. Industry analysts. Reports from analysts can provide insights where public data is limited. Accuracy matters here. Small errors in the data can lead to flawed conclusions downstream. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.